Hello, welcome to the channel. I am Taraknath. I am a qualified chartered accountant as well as cost accountant. In today's episode, let us discuss about net assets value method. This topic is part of valuation course that is being streamed in my YouTube channel. Before going to topic, thank you very much for supporting me by giving your valuable comments, by sharing the video with the users, and by liking the video content. Thanks a lot once again. Let us get into the topic now. In the previous session, we have discussed about valuation approaches. There are three broad categories of valuation approaches: cost-based, market-based, and income-based. In cost-based valuation approaches, we are now looking at cost to replace approach, which is also popularly called as net assets method or NAV method. Let us first look at the formula that is used in net assets value method. As we earlier discussed, the objective of this exercise is to identify business value, enterprise value, or firm value. So the word net assets itself indicate net of assets and liabilities. So assets minus liabilities will give you enterprise value, business value, or firm value. If it is a company or an entity which have equity shares in their capital, then this value divided by number of shares will give you net assets value per share. So what is a formula for net assets value per share? Net assets value per share is equals to assets minus liabilities divided by number of shares. Let us learn about a new concept called economical balance sheet. In an ideal scenario, balance sheet refers to presentation of assets and liabilities at a point of time. Let us say as on 31st March 2026. What is the value of my assets and liabilities? That is called as carrying cost. Carrying cost refers to cost of acquisition subtracted by accumulated depreciation. So whenever we are talking about carrying cost, it means cost of acquisition minus depreciation. So this is a regular balance sheet, that is presentation of assets and liabilities at carrying cost. If you are presenting your balance sheet at replacement cost, then that balance sheet is called as economical balance sheet. What is a replacement cost? Replacement cost can be defined as the amount required to buy and replace the existing assets. Let us say you have a machinery having book value in your books at 20,000, which means 20,000 is equals to historical cost, whatever you have acquired, subtracted by amount of depreciation that you have booked in the previous periods. So that is a carrying cost. But let us say you have to spend 75,000 to buy that machinery as of today. So that 75,000 is called as replacement cost. It is also called as market value. So presenting your assets and liabilities at current market price is called as economical balance sheet. When we are talking about net assets method, the assets and liabilities can be presented either at carrying cost or at replacement cost. If you are presenting your assets and liabilities at carrying cost, then that is called as book value per share. which means take the exact balance sheet, identify all the assets, identify all the liabilities, and identify their carrying cost, which is already there in the balance sheet as of today, and then consider that as a book value per share. Now, replacement cost. So take the assets and liabilities, identify the amount of cost that is required to buy the new asset in the same exact position, and identify the amount that is required to be paid to liabilities to exit from the liability position. Then such kind of balance sheet is called as economical balance sheet. And based on economical balance sheet, if you are arriving at net assets value per share, then that is called as fair market value per share or net assets value per share. Till now, is it good? Now, let us look at application of NAV method. Usually, or most commonly, the NAV method is used where income is very negligible. It means we are in a scenario where the component of income or the income generation for the assets is very minimal, but the cost to set up the assets is little huge. General example is considered as schools and hospitals because they operate as a non-profit organizations, but in current scenario that doesn't work out. So just giving an example that schools and hospitals may be a good example, but not now in the present scenario. Okay, this net assets method is used to calculate the insured value, or also called as IDV, in an insurance policy. The IDV refers to amount of insurance claim that can be given by the insurance company to the insurer. So we have a machinery in our premises. If that machinery is purchased at 75 lakhs in 2012, and as of today, in the books of accounts, its carrying cost is only 8 lakhs, which means its depreciation has been provided to 90%. And now you are going for an insurance for that machine, then insurer will value how much amount of outflow of cash will be there for the insurance company to buy this machine. So that is the insured value, and then we will calculate the incremental premium required for the insured value. So usually this NAV method is applied in the insurance cases. And NAV method is not suitable for real estate property valuation, especially residential real estate property valuation. So it is not ideal for residential real estate property valuation. Am I clear till now? Let us look at the limitations and drawbacks of this NAV method. In NAV method, historical cost is ignored. So whatever amount of cost that you have put into the purchase of these assets is not considered in this NAV approach. In NAV approach, intangible assets and contingent liabilities are excluded. So in the formula of assets, intangible assets is excluded. In the sum of liabilities, contingent liabilities are excluded. So that doesn't give a true picture. Assume there is a software company which is doing more research and development into AI models. It has a complete intangible asset in his books. And let us say the other company have filed a claim against the company saying that they have infringed their kind of copyrighted content. So there is a huge set of intangible asset and there is a huge set of contingent liability which might occur. So we are not including them in the net assets method. So that is a huge drawback. So the value that you are arriving is not a true picture. And the specific competition in the business is not considered at all. Like we are just working out the number of assets, the amount of assets that is required, but you are not even giving any hint for the income, not even giving any hint for the impact of the competition or impact of the market forces into the valuation. So this net assets value is not a good scenario. It is not possible to do a net assets value in sole proprietorship concerns, or if the assets and liabilities is associated with multiple usages. Let us say a sole proprietor is running a business and he is using a car. The car is used for his personal purposes also and for the business use also. Let us say you have taken the loan for that car. Now the liability is to be divided between business use as well as personal use, which is not accurately possible. So this net assets method has these all limitations. Thank you very much for watching the series. Thank you very much for watching these sessions, and let us stop the session today. We'll come with a new approach tomorrow. If you like the video, please give thumbs up for the video. If you know someone who wanted to listen to this content, share the video with them. Subscribe to my channel for more finance related content. Thank you. Jai Hind.